In this video, we're going to be looking at installment loans. An installment loan is a loan where you're going to pay a fixed amount each period, and that amount includes both principal and interest. So a lot of times your car loans, your home mortgage loans are going to be installment loans. The company is borrowing the money now, and then they're paying equal installments over the period of the loan. And when the last payment is made, the loan is paid off because each loan payment had a principal payment along with the interest payment. For us to record this in our books of accounting, we have to calculate the payment, and then we have to split that payment between the interest portion and the principal portion. And then something called the carrying value is what's going to be reported in the balance sheet at the end of every year for this loan. To help us with these calculations and to record our journal entries, we prepare something called an amortization table for the note. I will teach you how to do that, but the first thing we're going to do is let's read this example, and then I'm going to teach you how to calculate the payment. It says ABC Company borrowed $500,000 by issuing a 7% 5-year note on January 1st, 2020. Payments are due every 6 months beginning June 30th, 2020. So that's 6 months after the date the loan was borrowed. They want you to prepare an amortization table for the note, and they want you to record the journal entries on January 1st, June 30th, and then December 31st of the first year. The first thing we're going to do is calculate the payment. If you notice, they did not tell you the payment. They gave you all the information you need, but they didn't tell you how much the payment was. You have to use present value, future value tables to calculate that, or you can use Excel. In previous classes, you probably have learned how to do that using tables. It's really easy, but let's go ahead and do this using Excel since we're already on Excel here. Before we use Excel to calculate the payment, we're going to have to note down some of the information we need to use on that formula. So the first thing that you need to know is the present value. It's going to ask you what the present value is. Well, the present value of this note is how much the company is borrowing today. Look at the question, determine how much the company is borrowing. They're borrowing $500,000, so you're going to enter $500,000 as the present value. The next thing that you're going to want to know is the interest rate. How much is the interest rate? We know that the interest rate is 7%. We know that that's always an annual percent. However, you need to adjust that 7% if you're making more than one payment during the year. How many payments does this note require? The note requires 2 payments a year. Every 6 months we have to make a payment. So our interest rate is going to be the annual interest rate, which is 7%. And then you have to divide that by the number of payments per year. So in this case, it's 2. You're going to make 2 payments. So your interest rate that you're going to put in the Excel formula is going to be 3.5%. The next thing you need to know is the Excel formula called NPER, N-P-E-R. It's basically how many payments you're going to make on this loan during the life of the loan. So during the term, we know that the term is 5 years. You're going to make 5 payments, but it's not 1 payment per year. How many payments are you going to make each year? You're going to make 2 payments. So you're going to say 5 multiplied by 2. So I'm just going to multiply it by 2. It's going to be 10 payments over the life of the loan. Sorry, let me put that. So we need to know that we need to enter that in the formula as well. Finally, it's going to ask for future value. That's just part of the formula, there's no future value needed for this formula, so you're just going to put 0. Now let's go ahead and calculate the payment. You're going to type in equal, that's what you start your formula with, and you're going to type PMT. And it says here, calculate the payment for a loan based on constant payments and a constant interest rate. Do we have constant payments? Yes, we're trying to figure out how much it is, but it will be the same payment every period. And then a constant interest rate. The 7% doesn't change over the term of the note. So let's do that. We're going to open parentheses, and then it tells you the order that you're going to have to put these in. First, they want to know what the rate is. Well, we calculated that the rate was going to be 3.5%, and you do have to put the percent there. Then you have to put a comma. The next number is NPER, so that's the number of payments per period. I think I have a typo here. I said NOER, but it should be NPER, and that would be 10. Then, oops, that should be a comma. Then they want to know the present value. Present value, we said, is the amount of the loan, which is 500,000. And then future value, we're just going to put 0, and then type, we're just going to leave that blank, and we can close parentheses. And that's going to tell you how much your payment should be every 6 months. It's going to return a negative number, but don't worry, you can just change that to a positive number when you're putting it in your amortization table. So if we make payments of $60,120 and 68 cents, you would have paid off the loan by the end of 5 years. Now let's go ahead and use that number to calculate our amortization table. So the payment is going to be the same every year. I've already got the number of periods as 10 and the dates put in, so your first payment is going to occur on June 30th, 2020. And the amount of the payment is $60,120.68. I'm going to put it in decimals, however, it is going to be rounded up or rounded down or up to the nearest decimal. Now let's look at the interest payment. The interest is going to be 3.5%, because remember this is only for 6 months. It's going to be 3.5% the amount of our carrying value. Carrying value is the amount of the loan, the remaining amount of the loan. This is the first payment. So how much is the amount of our loan? Well, on June 30th, before we have made any payments, we still have a $500,000 loan. So I'm going to put that carrying value on this top line here. So I can use a formula, 500,000. And that's going to be the number that we're going to use to calculate the amount of interest for the first payment. I'm going to take 500,000. Then you're going to multiply that by the interest rate of 3.5%. And that will give you interest of $17,500. So of the $60,121, $17,500 is interest. The remainder is principal. To figure out how much the principal is, you take your total payment amount of $61.21 minus the amount of interest of $17,500, and it'll give us a principal payment of $42,621. Now, at the end of June 30th, 2020, we don't have a loan of $500,000 anymore. We've paid off some of that. The principal payment went towards decreasing the amount of this loan. So on June 30th, 2020, the carrying value, or the principal amount of this loan, is going to be the $500,000 we had before, minus the principal payment, which will equal $457,379. Make sure that you prepare your own Excel, or you can use Google Docs or other Google Sheets to do this calculation. That takes care of the first payment. Let's look at the second payment. The second payment, is that going to change? No, it's still going to be the same amount. So I'm just going to use that same number as the payment, 60,121, and that's basically rounded up, right? But my amount of interest is going to change because my principal is no longer 500,000. That has changed. So let's do that calculation again. It's going to be, and if you're using cell references in Excel, then this table is going to be very quick to do, but I'll do one or two more lines and then I'll show you how cell references will help. We know that our interest payment will be calculated by taking the amount of remaining principal, which is now 457,379, times 3.5%, which is the interest rate. That gives us interest to be $16,008. Does that look correct? It should, because interest should be less because our principal is less now. Our loan amount remaining is less. So our interest should be less. Now, our principal payment this time will be higher because we're still paying that same amount. So let's calculate the payment, the principal amount. It's your payment minus interest, which is 4,412, which gives a carrying value. This again, this is the amount remaining on the note. It's the previous amount of 457,379 minus the new principal payment of 4,412, giving you 413,267. If you've been using cell referenced in Excel, you can now basically click on these four numbers, use this handle and drag it down, and it will calculate the rest of your amortization table. If you don't use cell references, you can rework this table, calculate every number by hand, and then make sure you get the same numbers as I do. But practice using cell references because this will help you get practice on Excel, as well as make sure your homework and your assignments are done much quicker. Note that after the last payment is made, we don't owe anything on that note. We have completely paid it off. Now let's look at the journal entries. I have a little template for a journal here, so let's go ahead and do that. The first journal entry occurs on January 1st, 2020. That's when we borrow money. So on 1/1/2020, the company is going to, sorry about that, let me change that. The company is going to receive cash, so they're going to debit cash for 500,000 and credit long-term notes payable. And let me go ahead and format this so that it's easier to read. That's your first journal entry. The second journal entry occurs on June 30th when you make that first payment. So that's June 30th, 2020. Let's see what we're doing. We know that we are paying cash, we got an interest expense, and then we're decreasing the amount of the note. So what are the accounts affected by the transaction? We know cash is affected. Cash decreases. We know interest is affected, so interest expense. What happens to interest expense? Interest expense increases. And then what happened to the long-term note? When we pay some of the principal, that decreases. So using your debit credit rules, you're going to find that your interest expense increased. So we're going to debit interest expense for how much? The amount of that first interest payment, which is $17,500. along with that, we're paying down the notes, so our long-term notes payable decreases. So we're going to debit long-term notes payable. How much are we going to debit? It's the amount of the first payment, $42,621. $42,621. And then the credit would be what? We're going to pay cash. So we're going to credit cash. And how much cash? The amount of the payment, which is $60,121. $60,121. Do our total debits equal total credits? Yes, they do. So we're done with that journal entry. Now let's look at the next one. The next journal entry occurs on December 31st, 2020. On December 31st, 2020, what's going to happen? Same thing. We're going to have an interest expense. We're going to decrease a long-term note payable, and then we're going to pay cash. So I'm going to copy these three down here because we know that's the same journal entries, but the dollar amount changes. We're going to go with the second payment on December 31st, 2020. So on December 31st, 2020, your interest expense is going to be $16,008. Your long-term note principal payment is going to be $4,412, and then of course your cash amount remains the same at $61.21. That's it for this video. In the next video, I'm going to look at the same type of installment loan, but with interest accrual.